Exercise 12-3. We're looking at make or buy a component. So they're looking at switches. They currently manufacture their own. An outside supplier has offered to sell them the switch for $32 per unit. So do we make it or do we buy it? Here's the information costs on making it. So in part 1, assuming that the company has no alternative use for the facilities now being used to produce the switch, should they make or buy? Okay, so again, before we go ahead and look at the solution, let's think through. The costs that are going to be relevant are 1, the cost of purchasing. So if we purchase, it's $32 per unit. And cost of making, the cost that would change if we made or not. So if we stop making, if we make the switch, we are going to incur direct materials. And if we stop, we won't have to pay that. So that one is going to come into play. Direct labor, same thing. If we make it, we're going to have to spend that $10 per unit. If we don't, that's something that we won't have to spend. Variable manufacturing overhead, same situation. We'll incur it if we make it, but we won't if we don't make it. Fixed manufacturing overhead, traceable, so it is traceable to that product. And there's a little asterisk, and it says 25% of that is supervisor salaries, and 75% is depreciation of special equipment, no resale value. So of that $8, supervisory salaries, if we're not making the product, then we're not going to have to pay those supervisor salaries. Depreciation, sunk cost. The equipment, it's special equipment that's already purchased. It's happened in the past. It has no resale value. So if we stop making the product and we don't use that equipment, we're not going to get any money back for it. So it really has no bearing on our decision. And then fixed manufacturing overhead, common but allocated. Allocated fixed costs where it doesn't come into play. Those costs are going to be incurred whether we make the switch or if we purchase the switch. Okay, so now we can look at the solution. So per unit differential costs, purchasing, so I have 2 columns, one if you make, one if you buy. So purchasing, it's going to be $32 per unit. That's the only cost we'll incur if we purchase. If we make, like I just said, we're going to have to incur the $12 for direct materials, $10 for direct labor, $3 for variable manufacturing overhead. Of that original $8 that was in fixed manufacturing overhead traceable, 25% was for salaries, so that's $2. The remaining $6 was depreciation, which we said wasn't going to come into play. So just the $2 we will take into account. And the fixed manufacturing overhead common that was allocated out doesn't come into play. So now we can look and say, well, if we make it, it's going to cost us $27. If we buy it, it's going to cost us $32. Therefore, it makes more sense for us to continue making the part. All they did over here is we were given information based on 12,000 units per year. So again, they're just taking the individual unit amounts times 12,000 so that you can see again that it's 60,000 in difference. Part 2. Now it says, suppose that if the switches were purchased, they could use the freed capacity to, actually I'll flick back to the question so you can see. They can use the freed capacity to launch a new product. The segment margin of the new product is $78,000 per year. Now, what should they do? Should they accept it, the offer to purchase, or should they continue making? Let's go back to our solution. So, purchasing. Now we're going to compare total cost because what we were given is that full $78,000. So we're going to compare our totals. So if we purchase, which we calculated up here, it will cost us $384,000. If we continue making the product, it's $324,000. That are the additional costs that we would incur. But now we also have to look at something else. If we make the product, we're giving up the 78,000 per year that we could have segment margin that we could have gotten from another product. So in addition to spending 324, we're giving up 78,000. That's lost. So we add that to our cost and we get 402,000. So now in this case, because that idle capacity cannot be used to do something else, now their decision changes. Now they should purchase, because they can purchase for 384,000 and go ahead and make that other product line.